Welcome to Raymond Limited Q4FY24 earnings conference call hosted by Antique Stock Broking Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing the star, then 0 on your touchtone telephone. Please note that this conference is being recorded. I now hand the conference over to Mr. Abhijit Kundu from Antique Stock Broking Limited. Thank you, and over to you, sir.
Thank you, Steve. On behalf of Antique Stock Broking, I would like to welcome all the participants in the Q4 FY24 conference call of Raymond Limited. Today we have with us from senior management of Raymond, Mr. S.L. Pokharna, who is Director of Raymond Limited, Mr. Amit Agarwal, Group CFO, Mr. Sunil Kataria, CEO of Lifestyle Business, Mr. Harmohan Thani, CEO of Realty Business, and Mr. Jatin Khanna, Head Corporate Development. Without taking further time, I would like to hand over the call to Mr. Amit. Over to you, Amit.
Thank you, Abhijit. Good afternoon, everyone. Thank you for joining us today for the earnings call to discuss the results of the fourth quarter of fiscal 2024. I hope you would have received a copy of our results presentation. I would like to urge you to go through this along with the disclaimer slides. Let me start with a brief overview of the market for the quarter. The quarter took off slowly as discretionary spending was low at the backdrop of inflationary pressures, resulting in toned-down impulse purchases by the consumers. The K-curve recovery persists with low-income households curtailing spending while there is an upsurge in consumption of high-income households. As March progressed, there was an uptick in sales due to pre-Eid shopping. The real estate market maintains an upward momentum driven by increasing residential demand with expectations for this trend to persist in the forthcoming quarters. Additionally, there is a rise in demand for affordable luxury residences along with strong interest from first-time home buyers. Now let me talk about the fourth quarter of fiscal 24 performance. Raymond continues its growth momentum with the 11th consecutive quarter of growth, reporting the record-breaking performance both in terms of revenue and profitability. In the fourth quarter of 2024, Raymond reported its highest ever quarterly revenue of 2,688 crores, showcasing a 23% year-on-year growth over 2,192 crores and increased by 238 crores on quarter-on-quarter basis as compared to 2,450 crores reported in the third quarter of fiscal 24. The growth was driven by robust performance in our branded apparel, B2B shirting, along with outstanding performance in the real estate sector. I am delighted to share that we have also achieved the highest ever quarterly EBITDA of 516 crores in the fourth quarter of fiscal 24 with a record EBITDA margin of 19.2%. This marks a remarkable 36% year-on-year growth compared to 379 crores and an increase of 90 crores quarter-on-quarter from 426 crores in the third quarter of fiscal 24. This being landmark 99th year of fiscal 24, Raymond delivered its highest ever annual revenue of 9,286 crores and an EBITDA of 1,575 crores with a margin of 17%. Despite subdued consumer demand and challenging market conditions for the lifestyle business, Raymond's focused business approach across its operation led to robust growth in branded apparel, garmenting, as well as in the real estate segment, resulting in an impressive double-digit revenue growth of 11% in fiscal 24 as compared to previous year. The real estate segment delivered stellar performance throughout the year, securing a total booking value of 2,249 crores. The record-breaking revenue and EBITDA performance underscores Raymond's resilience, strategic vision, and unwavering commitment to excellence and paving the way for continued success in its centennial year and beyond. Overall, with the increased sales and cost optimization, the company has been able to report the annual profit after tax of 655 crores excluding the 983 crore profit gained out of the FMCG business sale, making a 24% increase compared to 529 crore in the previous year. Including the FMCG benefit of sale, company reported the net profit of 1,638 crore. Just to remind, during the year, Raymond Group sold its FMCG business for 2,825 crores. The strong business performance culminated in reporting highest ever EPS of 98 rupees, excluding the profit on sale of FMCG business, as well as board has recommended highest ever dividend of 100% to reward our valued shareholders for their continued support and trust. The growth was led by business branded apparel, in which we successfully leveraged the core strength of the brand coupled with our wide distribution network across the country. Despite muted consumer demand and weak market conditions, our strategic focus on expanding our distribution reach, as we demonstrated by opening over 200 new stores during the fiscal 24 and focusing on premiumization as well as casualization, resulted in strong growth for our branded apparel segment, achieving a 20% growth compared to the previous year despite weaker retail industry. In the garmenting segment, we are in the process of expanding our garmenting capacity by about one-third to participate in China Plus One adopted by most of the global brands. Also, this capacity augmentation is in line with the Government of India's Make in India initiative. The engineering segment performed well with resilient demand in the domestic market, while export orders were impacted due to challenges in the global market, and our future growth is led by completion of acquisition of Mini Precision in March 24, which forays into sunrise sector, aerospace, defense, as well as EV components, positioning us for exciting opportunities and expansion in these high potential segments. In fiscal 24, Raymond initiated major corporate actions aimed at securing long-term growth and enhancing shareholder value. These efforts were in line with our goal of achieving a net debt-free status and simplifying the group structure for maximum efficiency. Key initiatives included selling of the FMCG business for 2,825 crore, demerging the lifestyle business to unlock shareholder value, and strategically acquiring the MPPL Mini Precision business. Moreover, achieving net debt-free status 2 years ahead of schedule highlights our commitment to financial prudence and sustainable growth model. Now let me discuss about the segmental performance for the fourth quarter of fiscal 24. The branded textile segment revenue was maintained at 920 crore, a 2% growth over 902 crore in the fourth quarter of fiscal 23, despite muted consumer demand and challenging market conditions. The quarter saw mixed trends with moderate consumer sentiment affecting sales in the first half, but an uptick was observed later in the quarter. The EBITDA margin remained broadly flat at 21.9%. Let me talk about the branded apparel segment, which showed a healthy sales growth of 23% to 409 crore as compared to 332 crore during the fourth quarter of the previous year. In a weak market condition, our stated strategy of enhancing our distribution reach and network, focus on premiumization coupled with casualization led to growth in the branded apparel business. The growth was witnessed across all channels and brands, with Park Avenue, Park, Raymond Ready to Wear, and Ethnics by Raymond leading the front and well supported by the Color Plus brand. The segment delivered EBITDA margin of 13.4% in the fourth quarter of fiscal 24 as compared to 15.8% in the previous year. The EBITDA margin stood lower as compared to previous year because of increased investments in branding and category creation for Ethnics by Raymond and other brands through additional spending on advertisement and marketing initiatives to invest behind these brands. We continue to strengthen our retail footprint as we opened 39 new stores during the quarter, as well taking the tally to 1,518 stores as on 31st March 2024, which are spread across 600 towns and cities in India, including 114 exclusive outlets for the Ethnics by Raymond brand. Now let me talk about the garmenting segment, where during the quarter our revenue was 280 crore, which is lower compared to previous year due to ongoing Red Sea crisis and geopolitical issues. However, we continue to acquire new customers and enhance our presence in newer geographies. During the quarter, healthy EBITDA margin of 11.3%, a significant improvement from 6.6% compared to reported in the same quarter previous year, mainly due to better product mix and enhanced operational efficiency. Now let me talk about the high-value cotton shirting segment, where the top line grew by 14% to 213 crores as compared to 187 crores in the previous year, led by demand for linen fabric offerings to our B2B customers in the domestic market. EBITDA margin for the quarter was marginally higher at 11.5% as compared to 10.4% in the previous year, mainly due to operational efficiency. Now about the engineering business, which is consolidated under JK5 and Engineering Limited on an aggregate basis, the sales stood at 234 crores in the fourth quarter, a 7% growth as compared to 219 crores in the fourth quarter of last fiscal. The growth was driven by increased demand for our auto components in the both domestic as well as export markets, particularly for flex plates, bearings and ring gears. However, the engineering consumable category continued to be impacted due to sluggishness in export market. During the quarter, the business reported an EBITDA margin at 15.8%, which is slightly higher mainly due to better product mix. As part of our growth strategy in the engineering sector, during the quarter, Raymond completed the business acquisition of Mini Precision Product Limited. With its strategic acquisition, Raymond Group forays into sunrise sectors of aerospace, defense, EV components business. We are streamlining our operations by consolidating business of JK5, which does engineering consumables, Ring Plus auto components, Mini Precision auto components, aerospace and defense, and simultaneously through a composite scheme of arrangement, two new subsidiaries will be created, one which will focus on aerospace and defense, while the other would cater to the auto components and engineering consumable sectors, each charting its unique path of growth with a primary objective of value creation. Raymond will hold 66.3% in both the new subsidiaries. The remaining shares will be held by the Mini family and the minority shareholders, which is 28.5% and 5.2% respectively. Just for the reminder that on a pro forma basis for fiscal 24, the consolidated revenue of the engineering business, including Mini Precision business, was around 1,800 crores and the consolidated EBITDA in the engineering group was 270 crores. Now let me talk about the real estate segment during the quarter. In February 24, we have launched our first JDA project outside of Thane land in Bandra, Mumbai, which has received an overwhelming response with approximately 62% of the launched inventory sold within 40 days. Overall, during the quarter, we have seen a robust booking momentum and made a total booking of 840 crores across our projects. The construction momentum across all 6 projects is progressing well, demonstrating our commitment to timely delivery and adherence to high quality standards. A comprehensive update on the construction status of our projects is provided in our investor presentation. The real estate segment delivered stellar performance throughout the year, securing a total booking value of 2,249 crores. After the successful launch of our maiden project 10X Habitat, addressed by GS Season 1 and 10X Ida, during the year we have launched 2 new projects at Thane land, addressed by GS Season 2 and the Invictus by GS project. Currently, we have got 5 ongoing projects worth 9,000 crores on our Thane land, with a further potential to generate 16,000 crores, making a total potential revenue from Thane land of 25 to 27,000 crores of 100-acre Thane land over the next few years. Additionally, we have signed 2 new JDAs in Mahim and Sion, and with this put together, the revenue potential from the 3 JDA projects, including Bandra in MMR outside of our Thane land, will be in excess of 5,000 crores. Our Raymond Realty business, which offers affordable luxury apartments ranging from 1 to 4 BHK that caters to multiple segments of society, and our proven ability to execute the project at a faster pace, enabled the sales to increase by 134% to 677 crores in fourth quarter of fiscal 24 compared to 289 crores in the fourth quarter of fiscal 23 last year. The EBITDA margin of 25.2% for the quarter as compared to 24.3% in the same quarter last year. Now let me talk about the working capital and the cash flow. On the working capital front, with our continued focus on working efficient management of working capital, we have worked on an absolute term that our net working capital stood at 2,319 crore as at end of March 24. During the quarter, we have completed the acquisition of Miny Precision, resulting in an increase in additional working capital of 316 crore. Excluding the impact of Miny Precision acquisition, our net working capital days would have been 68 days, which is lower by 3 days on a quarter-quarter basis from 71 days in December 23. In fiscal year 2024, Raymond successfully completed the acquisition of MPPL. While the profit and loss statement of MPPL has not been consolidated into Raymond's financials, the balance sheet figures have been consolidated, offering a glimpse into the company combined entities financials. On the full year basis of fiscal 24, MPPL revenue was 935 crores and an EBITDA of 146 crores with an EBITDA margin of 15.6%. On the balance sheet, as reflected in Raymond's financial statements, the integration of MPPL's balance sheet has notably increased Raymond's asset base, with gross current assets amounting to 534 crores, comprising inventory valued at 251 crores, receivable at 199 crores, and other current assets totaling 84 crores, with a current liability of 217 crores. This results in MPPL net working capital of 316 crores. Further, the consolidation of many operations has significantly augmented Raymond's net block by 1,244 crores. Now let me talk about the consolidated debt position. Our total gross debt stood at 3,426 crores, which comprises of external gross debt of 1,726 crores and NCD issued by Raymond Limited to Raymond Consumer Care Limited of 1,700 crores. We continue to maintain liquidity with cash and cash equivalent of 1,758 crores as on 31st of March 2024, and our net debt stood at 1,667 crores, higher by 749 crores versus December 23, mainly due to acquisition of MPPL business for 682 crores and taken over net debt of 286 crores of MPPL. Post demerger and acquisition of MPPL, the Raymond Group still holds a net cash surplus of 680 crores earmarked for growth capital. The interest cost in the quarter is 104 crores, which is higher by 40 crores as compared to 64 crores in the same quarter last year. The rise in interest cost can be attributed to several factors: an interest cost of 38 crores on the NCD issued to RCCL, which will be netted off upon the completion of the demerger, as the effective date is set for 1st April 2023. Interest of 5 crores for the deferment of approval cost payment to Mahada for Bandra project. Now let me provide an update on the demerger of the lifestyle business. The proposed demerger of the lifestyle business is progressing well as planned, having already received SEBI shareholder and creditor approval. Further, NCLT hearing is scheduled on 9th May for the approval of demerger. Upon completion, this demerger will result into two distinct net debt-free listed entities, one focused on lifestyle business and the other on real estate and engineering. The first quarter began against a backdrop of cautious consumer sentiment marked by moderate discretionary spending and subdued consumer demand amidst inflationary pressure. The persistent K-curve trend reflects the ongoing dynamics of the market. We are actively participating and addressing challenges, including the constraint posed by limited wedding days in the first quarter and the impact of heat waves on the operations. Aligned with our guidance, we are on track to expand our retail footprint, and over the next 18 months, we plan to add almost 200 stores with the asset-light franchise model, led by increase in the store network for Ethnics by Raymond and all other apparel brands. In the real estate segment, in February 24, we launched our first JDA project in Bandra and following an enthusiastic response from customers, we subsequently introduced a new tower in the same Bandra project in late March. The positive reception underscores customer confidence in our high-quality offerings and the swift construction pace maintained throughout our projects. Furthermore, we are currently in advanced discussion to finalize new JDAs, which we will come back to you. On an engineering segment, auto ancillary segment is witnessing good growth. However, engineering consumable business has been weak in the export markets. To conclude, I would like to reiterate that Raymond Group will continue to have three distinct vectors of profitable growth. We are fully geared up in terms of unlocking the full potential at each of these businesses. And with strong free cash flow and no major capex requirement, Raymond Group will maintain a net cash positive on a going forward basis. Now we will take questions from all of you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use the handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Rohan from InCred. Please go ahead.
Yeah, hi sir. Congrats on a good set of numbers. I just want to check in the real estate division, we basically launched Raymond Vibes. So I just wanted to understand the current numbers that are there in the PPT. Is that specifically just for 10x Habitat?
Yeah, Harmon this side. So 10x Vibes is actually part of Habitat itself. It's a sub product over there. There is convenience shopping, which we have branded as Vibes. So it's a very small shopping area that we have. Only 100 odd units, 0.04 million square foot. So it's fully sold out. So there is nothing that we have left.
Understood, sir. And will we be having a similar concept in the other projects as well?
Well, it differs from project to project and depending on the location. This project was on a 30-meter wide road and it had frontage on the road, so there was an opportunity to do some convenience retail. It also helps the project since this is the first project that we are delivering in the Thana land, so it's good to have convenience shopping for the residents as well. But it will be from project to project, we'll have to take this call.
Sure, sir. And just one question on the branded apparel side. How do we expect the margins to sort of pan out in FY25?
Yeah, hi, this is Sunil here. So as you've seen, we have been delivering margin in the range of around, 12 to 14% overall post-Ind AS EBITDA. We have been very clearly focused on investing behind branded apparel. There are two areas which is happening. One is distribution through retail expansion and one is through advertising. So we will be continuing to invest behind advertising.
Hello. Sir, your voice is not audible. Ladies and gentlemen, we have lost a line for Mr. Sunil Kataria. Please wait a moment while we reconnect them. Thank you. Ladies and gentlemen, we have
Hello?
Mr. Sunil Kataria back with us.
Sorry, I don't know where the call got disconnected. But I'm saying, as I said, we will be focused in the coming year as well in behind both store expansion as well as brand building. And there will be a strong investment which will go behind investment on marketing. But given the, despite that, I think we'll be focused on improving a gross margin as well looking at a better margin in the current range itself.
Sure, sir. Just one follow-up. For Ethnics, what have we ended the year at in terms of revenue? And if possible, can you give us a store count breakup across our brands, Park Avenue, Raymond, and the others? That would be nice.
Overall, in Ethnics, we have mentioned that we have actually ended the 31st March at 114 stores. And that's almost close to doubling the numbers that we did in the last financial years. So overall today we are at, including Ethnics, we are at 409 stores, and which are broadly broken up across Park Avenue, Color Plus, and Raymond Ready to Wear and Ethnic stores. We are targeting next year to add another 200 plus kind of stores across all our brands.
Sure, sir. Thank you.
Ethnics revenue, I would say right now it's too premature to give you a run rate on Ethnics because this brand has a lot of seasonality. But I can tell you one thing, that the traction that we have seen on this brand in the second half of the year when the season came in is pretty much in line with the expectations that we set for ourselves.
All right, sir. Thank you. I'll get back in queue.
Thank you. The next question is from the line of Sameer Gupta from India Infoline. Please go ahead.
Hi everyone, and thanks for taking my question. Just taking it forward from where the previous participant left, some insights on the retail brand Ethnics. So you had 60 stores, around 60 stores at the start of the year, and if you can share broad parameters of performance here, sales per store, store level EBITDA, working capital, debt stock, any major KRAs that you can share, and what are the plans for Ethnics specifically in FY25? How many stores are we targeting? Is it also going to be mostly franchisee driven, or it's going to be a mix of both? What is the current mix of franchisee plus company operated? So the Ethnics part a little bit, sir.
So let me just take a shot at this. So actually our mix of stores and Ethnics would be skewed more towards a franchisee model. We would like to operate in a range of around 25% company-owned stores, primarily for our marquee stores, because there are stores which come across in malls, there are stores which come on very, very prime, high street, which also serve as, marketing brand building stores as well. So when we see any such kind of properties, we'd like to obviously if there are some very large stores that we want to do. So on those areas, we'd like to do a company-owned store. Otherwise, we'll do franchisee asset-light models. So that ratio would be broadly 25-75 kind of ratio. That's how we look at the mix. The current mix is also broadly in the similar range. In terms of store expansion, we are at 114 stores which we ended the year at. Would like to definitely look at crossing around 200 stores next year. If the markets remain good and they come back strongly in the second half, we could even look at expansion further beyond that. But yes, definitely we're targeting to cross 200 in the coming year. In terms of KRAs, as you all who track this market would know that this business has its own cyclical form, and we also see a lot of changes which happen along with wedding phenomena. So we have set certain KRAs which are linked to each season. Where we are in terms of each of this, I think in terms of the numbers that we set out for us, I would say we are close to around 80 to 90% in that range of the first season that we set out for us. And we're pretty much happy, even the fact that even though Q4 had wedding dates, it was still a muted and mixed wedding season which panned out, given that the brand had first year. But I think we have got a lot of things right in this brand. One, the product assortment is very, very appreciated by consumers. We got our pricing right. We got the store ambience right. We're getting it by and large in the right location. So I think the mix is looking good, and we're just hoping for coming good wedding season to pan out second half of this year.
Sunil, I understand that there is a seasonality, but roughly the stores which started at the start of the year would have seen the whole season, right? The whole wedding season, one full wedding season. So any metrics on at least sales per store or margins or working capital that you can share would be helpful.
See, on sales per square foot, I would say there are certain parameters that we set out for us. I wouldn't want to give you a number right now in terms of where we're tracking, but yeah, the goal, if I set it at 100, I would say that we have achieved around 80 to 90% in that range.
Got it, Sunil.
But I'll tell you what, because I would like to still see a full season, because if you see the store which I set out around 12 months back also, the first half of last year was again pretty much non-wedding season. So what we have really seen is around 5 months of wedding season in this year. So for me to really put to your finger, think, okay, has this store seen a full 2 cycles of wedding season? I don't think so. I can really comment on that right now, because not a single store has seen, let's say, 2 full wedding seasons.
Got it. Fair enough. I'll come back in the
future. It will be very premature for me to give you any number of any kind right now. It may lead to a different interpretation. But yes, I can tell you that yes, the number we thought we would, despite a very, very mixed bag of wedding season, especially in the JFM period, I think we're pretty satisfied with what we've been able to do, and we're in the 80 to 90% range of that.
Got it. And this full cycle, 2 cycles, you would expect to be done by end of FY25 only. Am I right?
End of FY25, because again, if you see in the first half of this year, it's going to be a very different kind of a season, that there are no weddings in the first full half this year. I mean, we've seen a very short wedding season of a week or so, or 10 days or so in April, and then actually there's no weddings at all till November.
Got it. Thanks for this, and I'll come back in the queue for any follow-ups. Thanks.
Maybe one input which I can further give you is that there is one new initiative we are doing parallelly on Ethnics, is that we know while this business will have its own very sharp seasonality, we are also doing some brand building around a new range called Smart Ethnics, which is a casual ethnic wear which we believe over a period of time can be built into a more everyday use, whether it's for the evenings, whether it's for hybrid work wear. So that is another segment that we have rolled out, and we are in this lean season, we have started brand building around that. It will take some time, but I believe this is another segment which can be built within the Ethnics brand itself.
And what is the kind of ASPs in this particular Smart Ethnics?
Smart Ethnics would have collections like kurtas, the short kurtas, the casual ethnic, very, very casual ethnic shirts, bundis. This will all be in the range of around, anywhere between 2,500 to 4,000 rupees.
Got it. Thanks. I'll come back in the queue. Yeah. Thanks.
Thank you. The next question is from the line of Abhishek Nagraj from All's Wealth. Please go ahead.
Hi, sir. Thank you so much for taking the question. This is primarily regarding the entire restructuring, the demerger, and the purchase of Miney's stake. The first question is, I want to understand, how did the promoters' shareholding in RCCL jump from 49 to 54%? It is a 5% increase. I know in the presentation it mentions that promoter infused 100% proceeds. So was it an equity allocation that was done? Like, if you could just explain the entire structure threadbare, it'll be helpful.
Yeah, sure. Yeah, absolutely. So basically, if you see the RCCL, which was holding the FMCG business, was held 49% by the promoter and 47% was held by Raymond. Now, when you do the demerger of the Raymond lifestyle business from Raymond Limited into the RCCL, the share of the proceeds of 2,800 crore, of almost like 1,400 crore, was for the promoter family. The promoter family did not take out the money and stayed invested. And by virtue of a swap ratio, the share swap ratio, based on the valuation of the lifestyle business, his shareholding got increased from 49% to 54.8%. And that is the way, and it has been done by the independent valuers. And at that point of time, if I recall right, the valuation of the lifestyle business was kept approximately 80% of the total enterprise value of Raymond Limited, including the subsidiaries.
Just a follow-up on this. So the first question is, why did we choose RCCL as the company that it needs to get demerged into? Why couldn't it be a new entity in itself?
Sure.
Let me just complete the two questions which are interrelated, and then we can open it up. The next question is, I did go through the scheme of arrangement, Ray Global, which holds RCCL, which is nothing but a holding company right now, which is where the promoter stake, etc., has been divided, etc., right? The swap ratio for a holding company which just holds RCCL is different from the swap ratio for RCCL itself, which is kind of what is resulting this into a 55% holding. Wanted to understand how did that happen?
So first of all, two things. If you look at it, the reason why the demerger of lifestyle business was done in the Raymond Consumer Care, answer is very simple. Raymond lifestyle business had always an operating debt to the tune of 1900 crores, whereas the cash which has come after the sale proceeds of the FMCG business was in RCCL. The best form was to do a demerger along with all its assets and liabilities and transfer it into the RCCL so they can knock off the debt between the external debt and the cash sitting in RCCL. So that is number one. As far as the Ray Global Holding is concerned, the Ray Global Holding holds 100% of RCCL. So therefore the value of Ray Global Holding is typically the value of the cash realized or the sale proceeds realized by RCCL, which is to the tune of 2800 crores, less of taxes, which is around 2200 crores. The swap ratio has been based on the 2200 crores, which is the net of tax proceeds and the value of the Raymond lifestyle business. And that is why the swap ratio has been made, and thereby the increase in the shareholding has moved from 49% to 54.88%.
Sorry to interrupt, sir. I would request Mr. Abhishek Nagaraj to please follow up in the question queue for the follow-up questions. Thank you. The next question is from the line of Kunjal Palan from Sohum Asset Manager. Please go ahead.
Hi, thank you for the opportunity. So I had one question. In slide number 13 of the presentation,
sorry to interrupt, ma'am. Can you please use your handset while speaking?
Hello, is this better?
Yes, ma'am. Thank you.
Yeah. So in slide 13 of the presentation, 30 crores is subtracted as corporate allocation from the segmental EBITDA. So as mentioned, this includes other income and corporate expenses. Can you give a breakup of how much will be the other income portion in this and how much will be the corporate overheads? And going forward, do we expect the corporate overheads to remain at these levels or do we expect them to go up in the coming years?
So there is no change in whatsoever in the corporate overhead over the last year or so, because all the restructuring or reduction of the rationalization of the cost has been done in the last 2 years back, and we are continuing with the reduced cost. So we are not expecting any significant change in whatsoever in the corporate expenses. And as far as the other income is concerned, if you see in our the SEBI financials, it is clearly highlighted that in the in the other income for the quarter, it is given as 79.6 crores, and for the whole year it stands to 266 crores.
Okay.
Which is primarily also includes some of the income which are relating to the dealer network, because there is a certain charge on interest on account of dealer network which we do and which is considered in the other income because it is a part of the sales business.
Understood. Yeah. Thank you.
Thank you.
Thank you. The next question is from the line of Kaushik Dhani from Abens. Please go ahead.
Thank you for the opportunity and congratulations on a good set of results. Okay, so also, in fact, I'm pleased to see that, this time the presentation has been pretty detailed and actually has solved a few of my queries. I think queries related to textiles, my previous participants have already answered. But I have got a question on the Maine acquisition. I think during the call, Amit said that, there would be probably a demerger of the aerospace and defense business from the JK files. I just wanted to know what sort of revenue profile the aerospace and defense business has, and are the margins really different from the current set of 15.5 sort of margins?
Yeah.
Question.
Yeah, no, absolutely. You see, the growth trajectory and the whole metal usage, you see, the auto ancillary business as well as the engineering consumable primarily consumes steel, whereas this business is the high noble alloys like titanium, Inconel and such things. So that is one reason. Plus, this business is more precision and the auto business is more like with large numbers because you are catering to a very different segment. So therefore, we felt that it is appropriate, and considering that we have reached a decent scale in both the businesses. So this business of aerospace, which you asked, is in the range of 275 crores as we seek in terms of revenue, and a very, very high growth potential. And obviously, the margin profile is significantly higher of this business, is almost in the range of 25%.
Okay, and this 275 crores is pro forma revenues, or these are total revenues?
The aerospace is the total revenue.
Okay, fine. And secondly, with regards to the real estate, I believe in the news media it was said that based on the JDAs and whatever land parcel has, we could have annual revenues to the tune of 3,500 to 4,000 crores over next 5 years. Am I right?
So I will give you the numbers. What I said was, even today in the morning on the channels I said, based on the current bookings, as you see, we have done 2,300 crore worth of pre-sales booking. Going forward, what I talk about is in the 3 to 4 years, we should be talking about a revenue of 3,500 to 4,000 crores going forward, considering as we scale up more JDA projects like the Mahim and Sion we have signed today, and which will be starting, let's say, somewhere in the range of 15-18 months. So that will add to the further revenue. So that way, we see clear path for us anything between 3,500 to 4,000 crore revenue over the next 4-5 years.
And what sort of debt or external funds could be required for the same?
Actually, as we speak today, we are sitting on a net cash positive in the real estate business, and based on the model which we have, we are not going to procure any land. It is all a JDA-led model, and in the JDA-led model, there is not so much needed in terms of a big, large upfront payment. And since our sales velocity and execution, it is a very, very fast pace, our peak cash requirement does not require a significant amount of debt. So even if you add, at the end of the day, Thane is also generating every year a significant amount of free cash flow. So we should be able to have a very decent leverage ratios in this business.
Any targeted IRR for this?
So we have said very clearly the return on capital employed for this business is 25% for any of the JDA projects which will be taken into.
Okay. Thank you so much and wish you all the best.
Thank you.
Thank you. The next question is from line of Dipesh Agarwal from UTI Asset Management. Please go ahead.
Yeah, good evening, gentlemen. My questions are bookkeeping questions for Amit. Amit, if I see the unallocable expenses adjusted for other income, since there is a sharp increase in other income, there seems to be a significant increase this year. What is attributed to the increase in the unallocable expenses?
No, see, unallocable expenses is basically on account of two things. Some of the advertisement and expenditure we have considered also in the unallocable because it is for the Raymond and distributed all across. So that is one. And some of the parts are also relating to the acquisition and the expenditure which are incurred for the sale of the businesses, like the FMCG business. These are the two businesses.
Okay, so at an EBITDA level, we have an unallocable of almost 267, 270 odd crores. So would this number be remaining in the same range or it will fall?
No, it will reduce further. Going forward, it will reduce further.
And how should we think about the split of this when we go for demerger between, say, lifestyle business and the real estate business?
Yeah, I think we are just on the working with through. I think by the next quarter, we should have that number ready.
Okay. And the other question is, in the presentation, you mentioned a surplus cash of 680 crores. What is that adjustment? Because the working capital of money is some 312 crores. So if we make that adjustment, it doesn't come to.
No. So two things. On Miney acquisition, we were sitting with a 1,500 crore cash. We paid for the 59% acquisition of Miney close to 700 crore. And we assumed also a debt of 300 crores from the Miney's working capital. If you add the two, that would result into a 682 plus let's say 1,000 crores. That would result that without the Miney acquisition, it would have been 1,700 crore cash.
Okay, sure. And lastly, if you can help us understand what could be the extent of impact of ethnics on the apparel margin, would ethnics be loss-making at the current juncture?
We are looking at a gross margin basis because when you do the advertisement and others, it has both the advertisement cost for the ethnics as well as it has the advertisement cost for other brands like Park Avenue and such things. So therefore, for the gross margin, we are in line with the industry. Below the gross margin, as we continue to open up the stores and everything, EBITDA margin is something which is one does not need to look into. And we are also more focused on the gross margin, that what we are buying the product and selling the product is absolutely appropriate or not.
Okay, sure. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Varun Singh from ICICI Securities. Please go ahead.
Yeah, thank you for the opportunity. So my first question is on the branded apparel business. Sir, what is the SSSG for the quarter and also for the year for us?
Sorry, what is the question, Varun? Can you repeat it? I couldn't hear you.
Sir, what is our same store sales growth number for the EBO revenue in the branded apparel business?
Yeah, so it is in the range of, it is a mid-single digit number, which we have clocked in Q4, which I would say within the positive side of the industry. And the numbers would be in the similar range for the year also.
Okay, sir. Thank you. And sir, my second question is in the ethnics business, currently what would be our revenue contribution looking like? Meaning that what would be revenue share from the Sherwani as a segment compared to non-Sherwani or even smart ethnics, which is a differentiated proposition for us?
Yeah. So Varun, smart ethnic is just starting out. So as I said, it's a new launch, and really would be able to comment on that maybe I would say 6 to 8 months down the line. Regarding Sherwanis, kurtas and other segments, kurtas roughly would contribute to roughly around 40 to 50 odd % of the business, and then the rest would come from the other wedding wear, which is like Sherwanis, Indo-Westerns, etc. Bundis would contribute another maybe roughly.
Sir, sorry, I lost you. Bundis would contribute how much?
Bundis would contribute around 10 odd %. Kurtas would be around 40 to 45 odd %, 40 to 50 in that range, and the rest would come from Sherwanis and Indo-Westerns, the wedding and summer. And one thing I also want to point out is the kurtas are also used during the wedding wear as well for ceremonies like the haldi, mehndi, etc.
Yeah, understood. And sir, my last question is in the ethnic segment, like how are we doing capital allocation with regards to ATL and BTL spends to build the brand?
So in this segment, there's hardly any BTL, if you ask me. Ethnic doesn't see any promotions, any end of season sales, any discounting. So the entire capital allocation is on brand building, which is above the line. So we are investing very heavily behind two things. One is we need to establish the brand ethnics for Raymond. So we need to clearly differentiate this as a retail destination brand for ethnic wear, and that is where campaigns are happening and the media is being spent across mass media as well as digital. So these two form the large part of our media budgets. And then the second part of capital allocation, the budgets go behind retail store marketing. Because as we are opening more and more new stores, there is very clearly a module that is there on how do we establish new store presence in that catchment for the first 3 to 4 months. So this is where the money goes. BTL is negligible.
Okay, sir, understood. That's it from my side. Sir. Thank you very much and wish you all the best.
Thank you. The next question is from the line of Himanshu Nair from Systematic Group. Please go ahead.
Yeah. Hi, good afternoon, sir, and congratulations on a good performance. The first question would be on the demerger. So you said 9th May is when the NCLT hearing is scheduled. So assuming all goes well there, by when can we expect the RCCL to get listed on the exchanges, sir?
I think the way it is progressing, Himanshu, should be end of July, mid-August. That is the time frame which we are looking based on the process, what we have prepared the timeline chart, various approvals and processes which is required. Is basically a timely process. So we expect July end or mid-August. By that time, in that 2 week period, we should be able to get it listed.
Understood. And the second bit is now after consolidating many, we are still left with 700 odd crores of net cash. And the fact that there are no significant capex plans and our cash generation should only pick up. So has the management thought about a medium-term capital allocation plan? I mean, between the three large growth vectors that you talk about, how much will be allocating to which vector, or what's our thought process there in terms of new inorganic opportunities as well?
See, Himanshu, as we continue, we believe there is a lot of opportunities in each of the businesses. As Sunil talked about, that there are adjacencies in the lifestyle business which we have and which could create a larger opportunity where initially you need to invest money. Like the way you have seen in the ethnic business, we have been able to expand to 114 stores. We are putting money behind the brand. So I think that is one very, very clear thought. Second is the garmenting capex, which we have talked that we are investing 200 crore of garmenting capex, becoming the third largest suit maker in the world. And that is again a very, very revenue accretive and a good opportunity business as India getting China plus one and every other theme. So that is the second thing. As far as engineering business, they are generating cash flows, and we believe there is a consistent, we need to put capex in order to further expand the capacity and also to innovate and bring newer products. And especially in the aerospace and defense, there is a huge opportunity. Today, India stands almost like 1.5% of the total aircraft component supply coming out of India. So there is a big opportunity there where we need to innovate and invest. Not very large, but small investments needs to make in order to create a better opportunity for us. And obviously the real estate, as I said, real estate is generating cash, which is deploying back the cash and putting money into the approval costs for the JDS, which then eventually get started. And with our sales velocity, let's say 18, 24, 30 months, you again see that whatever the money you have spent starts to release back and gives you cash flow. So I think we have all the three vectors of growth, which requires cash, and we should be adequately deploying there. As far as inorganic, anything interesting, you see, never knew how the mining precision came and it became a significant acquisition and it's going to help the business improve all the profitability, revenue, growth, and the valuations of the various businesses to unlock the shareholder value. This is again a great opportunity. So like that, we will be on a lookout, but can't say as of now anything substantial is there.
Understood. And final question, sir, would be on the B2B part of our lifestyle business, the garmenting and high-value cotton shirting. Given our product portfolio there, looks like our margins are relatively lower to competition. So are we happy with the margins out there, or where do you see margins heading from that 10-11% range in the medium term for the garmenting and cotton shirting businesses?
Okay, I'll take the question on this. So if you see within the garmenting business, we have actually been consistently improving our margins. They have moved very close to now 10-11% margins. And our current focus is on increasing the revenue of the garmenting business as well as improving.
Ladies and gentlemen, the line for Mr. Jatin has been dropped. Please wait for a moment while we reconnect them. Thank you.
No, I'm there. I think Sunil's line has dropped.
Sunil's line. Okay, let me take that question. No problem. Himanshu, I will take that question. Basically, if you recall, Himanshu, in the past, we were in that 7% zone, and we have moved to closer to double digit now. And I think there is a constant effort. And as you expand these garmenting lines, there's a lot of need for training the tailors and the designers and all these people. Because when we supply to the top brands, they want a perfect suit or a trouser or a shirt. So I think there is a lot of expenditure which goes into the training. So as we continue to expand, you would have that incremental training cost which needs to be incurred in order to be on a better side of the product. So that is one very clearly. As well as high value cotton shirting, you see, the best part is that it is a good product to have in order to get the trends and especially the volumes as we continue to grow the branded shirting business. This is something where we can see opportunistically get a good margin. But you can't expect a 20% margin in a B2B business, what you see in a B2C business. So therefore, these businesses will always be in that mid-teens kind of a margin vis-a-vis the branded textile business which delivers 20+% margin.
Understood, sir. That's it from me. Thanks and all the best.
Thank you.
Thank you. The next question is from the line of Saurabh Gilda from Motilal Oswal. Please go ahead.
Hello, am I audible?
Yes.
Yeah. Hi, I had questions on the real estate business. Congrats on the good sets of numbers. Just wanted to understand your pricing strategy for the Bandra project because it appears that it's quite barely discount to the micro market. So just wanted to understand how we have priced it. And secondly, during the launch of second tower, have we taken any price hikes? And third, for the overall project level, what is the margin that we are expecting? Thanks. Those are my questions.
So Saurabh, I don't think that impression is correct that we've launched it at a discount to the micro market. Now, Bandra East is comprising of two micro markets. One is a developed market which is towards BKC, and then when you cross the highway on the other side, that side is still developing. It is not fully developed in that sense. So the pricing over there is in the range of 31, 32, going up to 33,000 rupees. There are players like Shapurji and Rustamji who are active there on that side of the market as well. So we've actually launched at a premium to all these players. So I don't know how you got that impression, because on the other side the difference in pricing is almost 10 to 15,000 rupees. So that is a natural difference in the micro market pricing itself.
Okay, understood. And any price hikes in the launch of second tower?
Yeah, so we are on to our third tower now, and very soon we will be launching the fourth one also. So we have already taken one price hike from the launch price.
Okay. Can you quantify it or?
It's 500 rupees price hike we have taken.
And at
an average.
Okay. Thank you.
Thank you. The next question is from the line of Sanjay Parak from Soham Asset Management. Please go ahead.
Yeah, congratulations. So I just wanted to, Mr. Agarwal did say that, we could have a run rate of 3,500 to 4,000 crores per annum in real estate. And considering our margins at 25%, can we say that we will hit the 1,000 crore EBITDA on a yearly basis very soon in real estate?
Yeah, absolutely. I think that is a very clear path. If you see, it looks very simple is that if I have made, with the project being launched, 2,300 crores of a pre-sales booking for the year 23-24 without really having a significant JDA project launched. And that reflects very clearly that over the next 4-5 years, you should be able to get these kind of numbers as we continue. And it is very simple math. We are talking a 10 million square feet if you do under construction, 2 million every year in a delivery between 4 to 5 years of project phase. You are talking in Bombay, nothing is less than 20,000 rupees a square feet. So very comfortably, you can hit a 3.5 to 4,000 crore of a sales.
Sure. And this will be on what time frame? I just missed the time frame.
4 to 5 years.
4 to 5 years is where we would hit a run rate of 4,000 crores.
Yes.
So Sanjay, I mean, just to add to what Amit just now said, that if you look at our trajectory, it has been, quite fast-paced growth. But now we've hit a certain size. So going forward, you can expect, at least on pre-sales, approximately about 18 to 20% growth rate. At least for the next 2 years, you can assume that. So even if you were to extrapolate that, what Amit is saying will automatically happen in 3.5 years.
Surely. Very helpful. Secondly, the engineering business is less understood. So with this merger, how would this look like? Because the areas where you are catering, aerospace, defense, even auto ancillaries on the export potential is huge. So how do we think about this business in 3 years? I'm not getting to numbers, but how big can this become? Can you just guide us, please?
Yeah, sure. No, it is a very attractive and absolutely, as you said, that this is something which we believe with the Make in India theme, it's a great opportunity for the engineering businesses where we can build a large scale business. So just to give you a perspective that the top 15 auto OEMs are covered in one way or the other between Wing plus Aqua, our Raymond business, or Mini Precision, which is the newly acquired business. So that is something, it is very difficult to enter into the top OEMs. Now, since we have already the top 15 OEMs, it helps us in order to move forward and get a larger piece of the business. That's number one. The number two, aerospace and defense, as I mentioned and responded to somebody else, that today India is just about 1 to 1.5% of the global $100 billion aerospace component industry. Now, considering that aspect, India, the way it is grown, whatever opportunity is there, it is very easy for us because we have created a decent base of 275 crores and we are into the engine critical components and not the base. So in those components, what happens is you have once entry made, you can be there for tens of years. So I believe, and then we are also in the EV component, as well as if you see the engineering business is going to be headed by Mr. Gautam Maini, who is going to lead that business overall, and that he has been in this business for more than 40 years. So we got, in a sense, through this acquisition, a top technocrat entrepreneur to run the entire business. So as you said, 3 to 4 years, we have delivered an EBITDA to the tune of 275 crores in 23-24. Easily it could be a larger 450 to 500 crore business over the next 4-5 years.
Thank you very much and best wishes to the whole team.
Thank you.
Thank you.